For years, Sam Bankman-Fried was presented as the person crypto had been waiting for. At a time when the industry was associated with speculation, hacks, and anonymous founders, Sam appeared as the opposite. He spoke calmly, dressed casually, and explained complex risks in plain language. He didn't promise overnight riches. He promised stability, responsibility, oversight. In a system built on distrust of institutions, Sam somehow became an institution himself. To many, he wasn't just a founder. He was crypto's most credible voice. When markets crashed, Sam went on interviews to explain what happened. When firms failed, he positioned himself as the one stepping in to stabilize the system. He testified before lawmakers, openly supported regulation, and donated heavily to political causes. Venture capital firms trusted him, journalists trusted him, regulators listened to him, customers believed him. FTX, the exchange he founded, wasn't marketed as revolutionary or rebellious. It was marketed as safe, professional, mature, the kind of platform where large institutions, not just retail traders, could finally feel comfortable. And at the center of it all was Sam. The narrative surrounding him was unusually powerful, a mathematical genius, driven by logic rather than ego, motivated not by wealth but by a moral framework called effective altruism. According to that story, money wasn't the goal, it was a means to do good at scale. Risk-taking wasn't recklessness, it was optimization. That image mattered more than most people realized, because as FTX grew, its credibility depended less on transparent systems and more on Sam's reputation. The assumption wasn't that everything was provably sound, it was that Sam wouldn't allow it to be otherwise. Trust replaced verification, confidence replaced scrutiny, and for a long time, nothing challenged that belief, until it did. When FTX collapsed, it didn't fall apart slowly. It collapsed with shocking speed, revealing that behind the image of safety was a structure far more fragile than anyone had assumed. Billions in customer funds vanished. Internal controls were exposed as minimal or non-existent, and the person once seen as the industry's stabilizer became the focal point of its greatest failure. This story isn't just about an exchange that failed. It's about how one individual came to embody trust for an entire industry, and how that trust, once broken, exposed the risks of concentrating power, control, and credibility in a single person. The question isn't simply how FTX collapsed, it's how Sam Bankman-Fried became trusted enough that almost no one thought to look underneath. To understand how Sam Bankman-Fried came to hold that level of trust, it helps to look at how he understood the world long before crypto entered the picture. Sam grew up in an academic environment where ideas mattered more than appearances. Both of his parents were law professors at Stanford, focused on ethics, policy, and how legal systems shape behavior. From an early age, Sam was surrounded by conversations about rules, incentives, and outcomes. Not emotions or instincts, but frameworks. He showed an early aptitude for mathematics and analytical thinking. Problems were meant to be solved, not felt. Decisions were evaluated by logic, not intuition. People who knew him often described him as unusually confident in his reasoning, sometimes to the point of detachment. To Sam, if the numbers added up, the conclusion felt self-evident. That mindset followed him to MIT, where he studied physics. The discipline reinforced his belief that complex systems could be modeled, predicted, and optimized. It was also during this period that Sam became deeply influenced by effective altruism, a philosophy that argues moral actions should be judged by their measurable outcomes. In that framework, intent mattered less than results. If one path created more overall benefit than another, it was the better choice, even if it involved greater risk. Wealth in this logic wasn't a moral failure, it was a tool. The faster it could be accumulated, the more good it could theoretically produce later. This idea would become central to how Sam justified his decisions. After MIT, Sam joined Jane Street, a quantitative trading firm where markets were treated as mathematical systems rather than human stories. Trades were driven by probability, speed, and expected value. Losses were acceptable if the strategy made sense statistically. Emotion was a liability. Sam excelled in that environment, but traditional finance also came with limits: compliance, oversight, and separation of roles. For someone who believed efficiency was a moral good, those constraints felt less like protection and more like friction. Crypto, by contrast, offered a system still forming its rules, and Sam believed he understood it well enough to shape it. Sam Bankman-Fried entered crypto with the same mindset he had developed in traditional finance. Markets were systems, and inefficient systems could be optimized. In 2017, he founded Alameda Research, a quantitative trading firm built to exploit price discrepancies across crypto exchanges. At the time, crypto markets were fragmented and immature. Bitcoin could trade at dramatically different prices depending on geography and liquidity. For most participants, this volatility looked like chaos. For Sam, it looked like free money. Alameda moved capital quickly between exchanges, capturing arbitrage opportunities at a scale few others could manage. Profits accumulated fast, and within a short period, Alameda became one of the most powerful trading firms in crypto. Sam's reputation grew quietly, especially among insiders who recognized how much liquidity Alameda was providing. As the firm expanded, Alameda shifted from pure arbitrage into market making. That transition mattered. Market makers don't just trade, they shape markets. They influence liquidity, spreads, and price discovery. In a loosely regulated environment, that role came with enormous power and very little visibility. Alameda's success also revealed a structural limitation. The exchanges it relied on were slow, unstable, and often poorly designed. Outages, liquidations, and inconsistent rules created risk, not just for users, but for Alameda's own strategies. From Sam's perspective, relying on third-party platforms was inefficient. The solution, once again, wasn't restraint. It was control. Rather than adapting to existing infrastructure, Sam decided to build his own exchange, one designed around the needs of professional traders and large-scale market makers. That decision would lead directly to the creation of FTX, into a structure where trading power, exchange operations, and decision-making authority would increasingly concentrate around a single individual. And with that concentration, the conditions for both extraordinary growth and extraordinary failure were set.